All right, so today we're going to do an overview of the concept of the present value of learning about the present value of money. So let me go ahead and get this started for us. All right, so Appendix 14A, the concept of present value. So what we'll do is we'll understand the present value concepts and then also learn how to use the present value tables. So the mathematics of interest. So remember that a dollar received today is going to be worth more than what a dollar would be received a year from now, because you can put it in the bank today and have more than a dollar from a year from now. So remember that you're better off the money receiving it today than you would into the future. Because if you receive the money today, then you could keep it in the bank and you could earn interest or invest it. So let's assume that a bank pays 8% interest on a $100 deposit that you were to make today. So we need to figure out what would that $100 be worth in 1 year. And we see the equation F, which would be Fn equals P and then multiply in parenthesis 1 plus R. So F is going to be the balance at the end of the period, which is N. And that's what we're trying to find out. P would be the amount that would be invested today, and R would be the rate per period. So if we were to work this out, we have 100. We're going to multiply that by 1 plus 0.08. So that would be then, it would be, so you solve first for what's in the parenthesis and then multiply. So it would be $108 would be what would be how much it would be worth in 1 year. The $100 outlay is called the present value of the $108 amount that you would receive in 1 year. It is also known as a discounted value of the future $108 receipt. So now we also have the concept of compound interest. So we looked at simple interest. Now we're going to talk a little bit about compound interest. So what if the $108 was to be left in the bank for a second year? How much would the original $100 be worth at the end of the second year? The equation needed to answer this question is as shown. So again, F is the balance that would be at the end of however many periods. That's what we're trying to solve for. P is the amount that it gets invested now. R is the rate of interest per period, and N is the number of periods. So if we were to take that, we want to know what it would be in 2 periods. So it would be 100 times 1 plus 0.08 to the second power. So it would be $116.64. The interest that is paid in the second year on the interest that would have been earned in the first year is compound interest. So interest on interest is compound interest. All right, so computation of present value. So remember that an investment can be viewed in 2 ways, in its future value or its present value. In the example just completed, the present value was known and the future value was the unknown that we needed to compute. Let's look at the opposite situation. The future value is known and the present value is unknown, and that's what we're trying to compute. So again, let's assume that a bond will pay $100 in 2 years. If an investor can earn 12% on their investments, what would be the present value of the bond, or how much you would have to put to purchase the bond now in order for it to pay $100 in 2 years? So again, F is the balance that would be at the end of the period. P is the amount that gets invested now. R is the rate of interest per period, and N would be the number of periods. And so if we were to solve for that and just plug in and chug, we would come out that P, which would be the present value, is $79.72. This process is called discounting. We have discounted the $100 to its present value of $79.72. The interest rate used to find the present value is called the discount rate. And again, we can verify this amount as shown here, that if we put $79.72 in the bank today at 12% interest, it would grow to $100 at the end of 2 years. And we can also use the present value of $1 table that we can find in Appendix 14B-1 that is in your text in order to verify the accuracy of the $79.72 figure. An excerpt of the appropriate table is shown here on your screen. The appropriate present value factor would be 0.797. And so then that would mean that the present value then is going to be $79.72. So let's do a quick check. So how much would you have to put in the bank today so that you would have $100 at the end of 5 years if the interest rate was 10%? So again, we want to, so to do this, we want to find out how much we'd have to put in. So if we looked at that table, the factor comes out to 0.621. So if we multiply 100 by 0.621, we're going to come out with $62.10. All right, the present value. So this is good if it's one, it's going to be one payment that we're receiving, but it gets more complicated when it's an annuity where it's something that's going to pay out over a series. So let's take a look at that. So although some investments involve a single sum to be received or paid at a single point in the future, other investments involve a series of identical cash flows known as an annuity. So an example of this, you might hear maybe if you win, like maybe you win the lottery and they say they're going to pay so much out for 30 years. That's an annuity. So where they're paying you, rather than giving you a lump sum, they pay it out over years. Or if you have to pay a certain amount, then that would be an annuity. So let's look at Lacey Inc. They are looking to purchase attractive land, which is a $60,000 payment that would be due each of the next 5 years. So each year they would have to pay $60,000 for 5 years. What is the present value of this stream of cash payments? What is the discount rate at 12%? And so we can look at our table in Appendix 14B2 contains the present value of an annuity. So you have to use a different table. So instead of using the present value of $1, you're going to use the present value of an annuity table that tells us that. And the excerpt of it is shown here on the screen. And so the appropriate present value factor would be 3.605. And again, if we multiply, we're going to come out that the present value is going to be 216,300. And so again, if the interest rate is 14%, how much would you have to put in the bank today in order to be able to withdraw $100 at the end of each of the next 5 years? And we can multiply that. And again, 100 times 3.432 comes out to $343.30. So if we put that in the bank today, then you'd be able to withdraw $100 for each of the next 5 years. All right, so now we're going to look at Appendix 14C. Remember that 14B, there's not a video on that because it is only just those tables that you need. So there's not a video on that. And those tables you can look up, like if you're working, you can probably go ahead and look those up, I'm sure, on the internet. Just search, present value table. Of course, there's things built into Excel that you can use as well. So if you're working, you can do that. But so there is no video for 14B. And so we're looking at 14C, which goes over the income tax and the net present value methods. So looking at how, including the impact of income taxes into this. So let me go ahead and get this launched for us. All right. So again, Appendix 14C, income taxes and the net present value method. And so again, our learning objective is learning objective 8, which is to include income taxes in the net present value analysis. So again, simplifying assumptions. So again, a company's net income for financial reporting purposes equals its net taxable income. So whatever that net income is, that's what they're going to be taxed on. For us, we're going to say that the income tax is a flat percentage of taxable income. That's what we're going to say. That it's not going to change based on the amount. Obviously, when you're working, it will probably vary based upon how much. But for us, for our purpose, we're just going to say it's the same regardless of the amount. And we're also going to say that there were no gains or losses on the sale of non-current assets. So we didn't sell any machinery or anything else that we would have to, that would kind of throw a monkey wrench into this. For us and our purpose right now, we're just going to ignore that. Okay, so key concept. So to calculate the amount of income tax expense that would be associated with a capital budgeting project, we'll be using a two-step process. And the first step is to calculate the incremental net income that is earned during each year of the project. And our second step then is to multiply each year's incremental net income by the tax rate in order to determine the income tax expense. Now, a capital budgeting project's incremental net income computation includes the annual revenues, the annual cash operating expenses, the annual depreciation expense, and one-time expenses that are related to repair and maintenance. A capital budget project's incremental net income computation would exclude the initial investment in equipment, other assets, and installation costs, the investments in working capital, the release of working capital, and the proceeds from selling a non-current asset when no gain or loss is realized in the sale. So we'll look at an example, income taxes and net present value analysis. So Holland Company owns the mineral rights to land that has a deposit of ore. The company is deciding whether to purchase equipment and open a mine on the property. The mine will be depleted and closed in 5 years, at which time the working capital would be released and would be redeployed by the company. So they're saying that after 5 years, the working capital that keeps this mine open, we're able to use elsewhere. And they're saying it's depleted, meaning that we're not going to be able to get any more ore out of it, or it's not going to be worth it to try to, get more ore out of it in 5 years. So we want to know, should they open up the mine? So pertinent information is shown. In addition to this information, the company uses straight line depreciation for financial reporting and tax purposes. And so our question is, should Holland open a mine on the property? So the initial investment equipment is going to be $270,000. The initial investment in working capital is going to be $50,000. The estimated annual sales of ore would be $250,000. The estimated annual cash operating expenses are $150,000. The cost of road repairs needed in year 3 would be $30,000. There won't be a salvage value on the equipment. And after tax cost of capital is 12%, and the tax rate is 30%. So The incremental net income computations include the annual sales, which is 250,000, the annual cash operating expense of 150, the road repairs that would be needed in year 3 of 30,000, and the annual depreciation expense of 55,000. So we come out, the total for those years would be, and it's broken down here on the Excel sheet that we see on our screen, but it works out that it would be 275,000 divided by 5 years. And that's how we get that. Now, the incremental net income in years 1, 2, 4, and 5 is 45,000, whereas in year 3 it would be only 15,000. Now, each year's incremental net income is multiplied by the tax rate, which is 30%. And so we come out that the income tax expense in years 1, 2, 4, and 5 is going to be 13,500. And we see that in year 3, it would be 4,500. And again, we do this. Notice that it's in parenthesis because it is a cash outflow that's taking place for taxes. So that our net present value computation includes the initial outlays for the purchase of the equipment, which was 275,000, the investment in working capital, which is 50,000, the annual sales, which is 250,000, the annual cash operating expense, which is 150,000, the road repairs that would occur in year 3 of 30,000, and release of working capital in year 5, which was 50,000, and the annual income tax expense for years 1 through 5. And so we see what the net present value would be. So each year's total cash flows get multiplied by the appropriate discount factor of 12% to compute their lesser present value. For example, the total cash flows in year 3, which of 65,500, are multiplied by the discount factor of 0.712 to obtain their lesser present value of 46,636. The present value that we see in cells B22 through G22 in here are combined to determine the project's net present value of $231. Because the present value is positive, the net present value is positive, it indicates that Holland Company should proceed with the mining project. So they do come out with a net present value, so they could go ahead and do this project.